April to August fiscal deficit at 38.1% of FY26 budget target of 15 rupees and 68 paise lakh CR. April to August fiscal deficit at 5 rupees and 98 paise lakh CR versus 4 rupees and 35 paise lakh CR year on year. April to August capital expenditure at 4 rupees and 31 paise lakh CR versus 3 rupees and 1 paise lakh CR year on year. If the government says fiscal deficit up by 40% or deficit is already 38.1% of full year target by August, it implies higher borrowing requirements earlier. To fund the excess, the government must borrow more via bonds, treasury bills than planned in that period. Accelerated spending, especially capital outlays. Often, the spike comes from increased capital expenditure infrastructure, roads and others, which is productive spending but still needs funding. Revenue shortfalls. The rise may also reflect weaker revenue, tax collections, non-tax revenue than expected, forcing the government to cover gaps via borrowing. Higher risk and market pressure. Bond yields may rise as supply of government debt increases. Inflation expectations may rise if markets think deficit will be monetized partially. Currency may come under pressure if foreign investors get concerned about fiscal health. Confidence and credit rating agencies will watch for whether this widening is temporary or structural. Signal about fiscal discipline credibility. Investors will assess whether this is a one-off overshoot or if the government remains committed to the planned deficit path and to reducing the debt burden later. The number reflects stress or ambition in government finances, and markets will try to gauge whether it is manageable or alarming. For more such updates, follow Dr. Stocks.